and get some analysis with Judo Bank Chief Economic Advisor Warren Hogan. Warren, let's start with some of the ugly numbers in this, including on productivity. Really, as you've described it, productivity is kaput. And when you put that alongside the warnings from Mike Henry, the BHP chief, and others, that the IR policies at the moment are going in the wrong direction, that they're going in the wrong direction when it comes to driving productivity. Where are we at right now on that issue?
Yeah, hi, Kieran. Look, productivity is kaput. It fell in the quarter. It's down over the year, and it's at the same level as it was at the beginning of 2018. And of course, productivity is what drives increases in real wages, increases in profits for investors. So this is bad news, but there is light at the end of this tunnel. We have this technology coming through in terms of supercomputing, AI, all sorts of businesses are investing in this, and we should get a lift. But the key to it is being able to readjust our workforce, to get people out of roles that will be done by computers into roles that they need to do in various parts of the economy. And the IR laws are going to make our very restricted labour market even more restrictive, and that's the opposite to what we need right now to take advantage of all this technology over the decade ahead. So I'm with Mike Henry. Yeah. I think we're on the wrong path here.
Mike Henry says that includes recent and proposed changes to IR, including same job, same pay and multi-employer bargaining. Why is that not fit for purpose in the economy as we go forward?
Essentially, we have such a dynamic economy lying ahead of us. I mean, it's already starting to play out that we don't know exactly what people need to be in what jobs, what skills. And the history shows the only way to let that happen and work it out is to allow the marketplace to send the signals with higher pay to attract workers. But if you lock people into certain wage levels, lock them into certain jobs and discourage them from moving jobs, that short circuits that process. And you can see what a restrictive IR system does, and we've had one really for the last decade. When that inflation came through 2 years ago, we couldn't see our wages go up because everyone was locked in, and that meant our real incomes and our standard of living went down. Whereas in places like the US and the UK, wages lifted and the people were able to sort of protect themselves against inflation. So that's just an example of why a rigid, highly regulated labour market is not going to work for the people of Australia and our economy going forward.
So on the broader number, the recovery in household income and spending, that was some good news in there, but does it run counter to the prospect of a rate cut anytime soon?
Well, it probably does, yeah. I mean, I think the reading of the numbers yesterday is not great. I mean, the headline numbers don't look fantastic, but there's a lot of detail and there's a lot of complexity to this economy. So the key thing in this economy is the downturn over the last few years was entirely the result of pressure brought to bear on household incomes because of inflation primarily, but also because of bracket creep and higher taxes, and of course the higher interest rates. We saw in the quarter the first signs of a recovery in household income, the best annual growth in 3 years. Consumers didn't spend it. That's why the saving rate went up. But we're seeing signs that they are starting to spend it in September and October. Black Friday was looking pretty good. So I think we've got the green shoots of a genuine turnaround in not just household finances, but consumer spending. And the number itself showed consumer spending flat, but that's because all those subsidies were counted as government spending. If there were no subsidies, we would have seen consumption grow by about 0.4 or 0.5% in the quarter. So I think the numbers are overstating the weakness on the consumer and definitely not projecting a better consumer heading into 2025.
So you don't think there is, this could be the tip of the iceberg, that things are softer than what many had expected, including the RBA, which thought annual growth would be at 1.5% by the end of this year. It's at 0.8%, Warren.
Yeah, well, we got some pretty unusual revisions, which meant that the annual numbers are a lot lower. And look, these numbers are going to get revised as well, so we've got to be careful with them. But look, the RBA forecast for GDP, they're not too far off. And let's see what we get next quarter. We had a big rundown of inventories, which was probably unexpected. That should bounce back. So I'm not too concerned about that. I think the narrative that this displays a really weak consumer and really weak business is not the right narrative. The weakness is in the past, and the most likely outcome is improvement. I'm not talking about booming consumer or business investment, but I'm talking about a much better outlook for 2025.
Warren Hogan, thank you as always. Appreciate your insights. Talk to you soon.